All right, let's get into it. Today, we're going to deconstruct a really powerful financial machine. We're talking about a set of strategies designed not just to make money, but to build and, more importantly, preserve wealth for generations. We're going to break down exactly how this whole system is engineered piece by piece. So, to really get how this machine works, we have to start with a totally different way of thinking, and this quote just nails it. The entire strategy, at its core, revolves around this one idea. Debt isn't the enemy, it's a tool. The real obstacle you have to plan around, that's a taxable event. It's a complete flip of how most of us are taught to think about money. So here's our game plan for putting this machine together. First, we'll look at the incentive system, the rules of the game. Then we'll add the fuel, which is appreciating assets. After that, we'll install the engine, strategic debt. From there, we'll fine-tune the whole thing with an optimization blueprint. And finally, we'll look at the ultimate output, the generational transfer of that wealth. Okay, first things first. Let's talk about the basic operating system behind all of this. It really comes down to shifting your mindset from just, following financial rules to actually building a proactive strategy. And here is the absolute key insight. The tax code, it isn't just a bill you have to pay. It's really a big map of incentives. The government is basically saying, hey, we want you to invest, to create businesses, to build housing, and it uses the tax code to give you rewards for doing exactly those things. Understanding that is the first step to playing a completely different game.
And this slide just lays out the two different games perfectly. Most people are on what we'll call the W-2 employee path. You know the drill. You earn a paycheck, taxes get taken out right away, and then you figure out what to do with what's left. But the investor/owner path, it's a totally different loop. You start by acquiring assets, then you use those assets to get capital, you spend or reinvest that capital, and then you use deductions to handle the tax side. It's a cycle, not a one-way street.
All right, next up, let's talk about the fuel for this machine. Every engine needs fuel, and in this financial machine, that fuel is what we call appreciating assets. This is the bedrock that everything else is built on. So what are they? Well, simply put, appreciating assets are just investments that are expected to go up in value over time. But here's the magic trick, the most important part. That growth, what's called an unrealized gain, isn't taxed. So if you own a stock and it doubles in value, you don't owe a dime in tax on that gain until you actually hit the sell button. This lets your wealth compound and grow year after year without getting whittled away by taxes. And we're talking about a whole range of things here. Real estate is the classic example, of course, but so are stocks and broad market index funds, even things like precious metals, say gold, or the actual equity you own in a private business. All of these can be the foundational fuel for this machine. Now we get to the engine that makes the whole system go. And this is the part that feels, really counterintuitive to a lot of people. It's the strategic use of debt to create liquidity. Basically, to get cash in your hand without triggering a huge tax bill. This right here, this is the linchpin. This is the one little rule that makes everything else possible. When you take out a loan, the money you get in your bank account is not considered income by the IRS. It's just debt. That is such a critical distinction, and it's what unlocks the entire strategy of accessing the value of your wealth without having to sell your assets. So how does this cycle actually work in practice? Well, it's a pretty straightforward four-step process. First, you acquire one of those appreciating assets we just talked about. Step 2, once it's grown in value, you borrow against it. Step 3, you take that loan money, which is tax-free, remember, and use it to buy another appreciating asset. And the final step is you just make the loan payments, which are often covered by cash flow from the new asset, all while both of your assets are hopefully continuing to grow. You're building wealth in two places at once.
And of course, there are specific tools for this job. If your asset is a piece of real estate, you'd probably use something like a home equity line of credit, a HELOC, or a cash-out refinance. If you've got a big stock portfolio, you might use a securities-backed line of credit, sometimes called an SB-lock or a margin loan. And if you own a business, a good old-fashioned business line of credit does the trick. The tool just depends on what you're using as collateral. Okay, so we've built the machine, we've turned on the engine, now what? Well, now it's time to fine-tune it. We want to get maximum efficiency, and that means using specific tax strategies to reduce any drag on the system and boost its output. And one of the biggest tuning tools in the toolbox is something called accelerated depreciation. So instead of deducting the cost of an asset really slowly over, say, 20 or 30 years, the tax code lets you take a huge chunk of that deduction right up front in the first few years. This creates a massive paper loss that you can use to offset other income, which can seriously slash your current tax bill. And there are some seriously powerful ways to do this. There's Section 179, which is often used for business vehicles. Then you've got 100% bonus depreciation, which is amazing. It lets you write off the entire cost of certain assets right away in year one. Think vehicles over 6,000 pounds. And for real estate investors, a cost segregation study is a game changer. It's like taking a magnifying glass to a property and finding all the stuff like carpet, fixtures, appliances. They can be depreciated way faster than the building itself.
You know, even with something as common as a business vehicle, there's a strategy to it. The standard mileage method is super simple, right? You just track your miles and you're done. The actual expense method, on the other hand, is more work. You have to track gas, insurance, everything. But it's the only way you can use those super powerful accelerated depreciation methods we just talked about, and that can often lead to a way bigger deduction. So we've built the machine, it's running like a dream, but what's the end game here? What is the final, ultimate purpose of this whole thing? Well, it's to make sure the wealth it creates can be passed on, preserved for the next generation. For real estate, a classic strategy for this is sometimes called swap until you drop. It uses something called a 1031 exchange. Basically, an investor can sell a property and, as long as they roll all the money into a new, similar property, they pay zero capital gains tax. You can do this again and again and again, deferring taxes for an entire lifetime. But here's the final incredible step. At death, the heirs inherit that final property and its cost basis gets stepped up to whatever its current market value is. And just like that, poof, decades of deferred capital gains taxes are completely wiped out. The tax liability just vanishes. Now you might be thinking, okay, but what about estate taxes? The reality is, for the vast majority of people, they're not really a concern. Right now, for 2026, the federal exemption for a married couple is expected to be around $30 million. That means your estate has to be worth more than that before a single dollar of federal estate tax is due. So while some states do have their own taxes, this massive federal number means this machine can transfer a whole lot of wealth without getting hit. So we've taken apart this incredibly powerful wealth-building machine. We've seen it's built on a few simple principles: own appreciating assets, use strategic debt for liquidity, and optimize everything with the tax code. And it really leaves us with one final big question to think about. What happens when these exact same principles of leverage and system design are applied not by one person, but at the scale of an entire national economy? What does that machine look like?